Welcome to Breaking News to Trading Moves. We are looking directly at a very specific headline that crossed the wires for you today. And, well, it reads exactly like this. Abbott Laboratories delivered a stronger than expected second quarter and raised its full-year profit outlook as medical devices and cancer diagnostics strengthen.
Yeah, and behind those seemingly standard financial figures, there is basically a brutal tug of war happening. Because for every single dollar a company like Abbott makes in that operating room, you know, someone else is forced to foot the bill.
Exactly. So today we are looking strictly at this headline to outline the exact mechanics of who is getting wealthy off this news and, who is getting squeezed out of the market entirely.
Right, and to map out those winners and losers for you, we really have to isolate the raw data driving the announcement first. So for the second quarter, Abbott's revenue reached $12.59 billion.
Okay, $12.59 billion.
Yeah, and their adjusted earnings came in at $1.31 per share. But the specific metric that matters most to the market, the one everyone looks at, is the future guidance.
Right, because the market is always looking ahead.
Exactly. So they actually increased their 2026 adjusted earnings per share forecast. It went up to a range of $5.45 to $5.60,
Okay.
which is an increase from the previous $5.38 to $5.58.
And you can see the market reacting to those updated numbers in real time. I mean, shares of ABT rose around 12%. Investors really just zeroed in on resilient demand across three specific categories. We're talking cardiovascular devices, diabetes technology, and cancer screening.
Yeah, and when you look at the segment breakdown, the mechanical proof of that demand is just, well, it's right there in the revenue numbers.
How so?
Well, medical device sales increased by 9%, reaching $5.85 billion. And meanwhile, diagnostics revenue reached $3.09 billion.
Wow, okay.
Yeah, and a key factor driving that diagnostics number actually included the Exact Sciences acquisition. That's where Cologuard generated mid-teens growth from both new and repeat users.
So Abbott is showing just sheer strength in their revenue and their forward guidance.
Well,
And that brings us to the first group of winners, based purely on these results. Because if Abbott is pushing that much volume, well, the market assumes the peers operating in those exact same physical hospitals are experiencing a similar tailwind.
right. That assumption is exactly what drives the valuations across the diversified medical device space.
So who are the peers winning here?
The clear winners among these peers are Abbott Laboratories, ticker ABT, then Boston Scientific, ticker BSX, Stryker, ticker SYK, and Medtronic, ticker MDT.
Okay, so ABT, BSX, SYK, and MDT.
Yes. Abbott's stronger results directly challenge these lingering fears that broad device demand might be weakening, due to macroeconomic pressures.
Right, because people were worried that inflation or the economy would slow down medical spending.
Yeah.
But a lot like owning a house. I mean, if you really want to buy an 80-inch television, but you wake up and your roof is actively caving in, well, you are buying a roof.
Yeah, the television can wait.
Exactly. A pacemaker or a spinal implant is not discretionary spending. It is the ultimate unavoidable expense.
And that structural necessity is the entire investment thesis for these companies. Like you said, a leaking roof is an unavoidable capital expenditure for a homeowner. Well, a cardiovascular intervention is an unavoidable medical expenditure for a patient.
You can't just skip it.
No, you can't. These companies are completely insulated from broader consumer spending downturns because their products are tied to physiological necessity. I mean, a patient does not check the consumer confidence index before getting a heart stent.
Right, that physiological necessity drives the hospital volume, and that volume drives the predictable revenue. But let's look at the chronic care side of this, because the headline specifically mentioned diabetes technology as a core driver.
Yeah, the diabetes and chronic care technology companies are just direct winners here. We are looking at Insulet, ticker PODD, Tandem Diabetes Care, ticker TNDM, and Edwards Life Sciences, ticker EW.
Okay, so PODD, TNDM, and EW.
Exactly. The underlying data from Abbott explicitly shows that patients managing diabetes, cardiovascular disease, and cancer are just highly unlikely to postpone their treatments, regardless of what the broader economy is doing.
Wait, okay, I understand why Insulet and Tandem belong in that group. I mean, their core business relies on insulin delivery systems.
Right.
Diabetes requires daily continuous management, so that creates a highly predictable razor and blade style recurring revenue stream for the hardware and the consumables. But how exactly does Edwards Life Sciences fit into this specific category?
Well,
Because the heart valve replacement is not something you manage daily like insulin.
no. And that is a very important distinction to make. Edwards Lifesciences operates in structural heart procedures, which, you're right, feels like a one-time event rather than daily management.
Right, you get the valve fixed and you go home.
But the business mechanic relies on the exact same undeniable urgency. A structural heart defect is a degenerative, chronic condition that ultimately forces an intervention.
Oh, so it just gets worse until you have no choice.
Exactly. Just like a diabetic patient cannot simply decide to skip their insulin for a month to save money, a patient with a failing heart valve cannot indefinitely delay a transcatheter aortic valve replacement. Both business models depend entirely on resilient, non-discretionary medical need.
Which takes us right inside the hospital doors. If patients are actively showing up for these unavoidable chronic treatments and interventions, the hospitals themselves need the physical hardware to perform the procedures.
Yeah, and that dynamic lifts the next group of winners. We're talking about the procedure-dependent surgical technology companies.
Okay, so the companies making the actual tools for the surgeons.
Precisely. The primary beneficiaries in this space are Intuitive Surgical, ticker ISRG, Johnson & Johnson, ticker J&J, and Zimmer Biomet, ticker ZBH.
So ISRG, J&J, and ZBH.
Correct. The mechanics driving their success are firmly rooted in the hospital capital expenditure cycle. Abbott's cardiovascular growth suggests that essential and semi-elective treatments are holding up incredibly well.
Let me stop you on that term, though. Semi-elective.
Yeah.
Because when we talk about something like an orthopedic joint replacement, are patients simply realizing they can no longer tolerate the delay? It seems to me that a knee replacement is elective right up until the pain makes it absolutely essential to function.
Yeah, that's exactly it. The clinical reality perfectly mirrors the financial reality in that regard. A knee replacement is technically classified by insurance as elective, but
nobody gets a knee replacement for fun.
right. As the degenerative condition worsens, the patient eventually reaches a breaking point where the surgery becomes functionally mandatory. Abbott's volume numbers tell us that patients are actively crossing that pain threshold and booking the operating room.
But how does a high volume of knee replacements and heart stents directly improve the sentiment for a company like Intuitive Surgical? I mean, they sell multi-million-dollar robotic arms. A surgeon uses a robot, sure. But how does Abbott's consumable data trigger a massive hardware purchase?
So think about the mindset of a hospital administrator. For a company like Intuitive Surgical, which manufactures the Da Vinci surgical robots, the hospital's purchasing decision is entirely reliant on sustained procedure volume.
Because they have to justify the cost.
Exactly. If an administrator sees their operating room sitting empty, they will never approve the budget for a $2 million robotic system.
Makes sense.
But when Abbott proves that procedure volumes are high, robust, and resilient, while hospitals are suddenly generating the baseline revenue required to actually justify those big-ticket capital expenditures.
So Abbott selling high volumes of everyday consumables basically acts as the green light for the hospital chief financial officer to go buy the expensive toys from Johnson & Johnson and Zimmer Biomet.
Yeah, the consumable volume provides the financial confidence required to keep the hospital capital expenditure cycle active.
Okay, I see. But every transaction has two sides. So the hospitals have the cash to buy robotic arms because Abbott's data shows the operating rooms are full. Patients are getting their knees replaced, their glucose monitors attached, and their cancer screenings completed. Someone has to actually write the checks for all of those medical bills.
And that leads us directly to the losers in this financial update.
Who are we looking at?
The primary companies taking a hit here are the managed care insurers. Specifically, we are looking at United Health Group, ticker UNH Humana, ticker HUM, Elevance Health, ticker ELV, and CVS Health, ticker CVS.
Okay, UNH, HUM, ELV, and CVS. You know, it is the ultimate all-you-can-eat buffet scenario.
I mean.
Well, this high utilization is fantastic for the hungry diners who are the patients finally getting their treatments. And it is incredibly lucrative for the food suppliers, which are companies like Abbott and Intuitive Surgical selling the equipment.
Oh, I see where you're going.
Right. But it is an absolute nightmare for the restaurant owner who is forced to fit the bill for all that consumption.
That is a perfect way to look at it. The insurance companies are the restaurant owners in this scenario, and they are getting squeezed by a very specific metric. It's called the medical cost ratio.
Medical cost ratio. Okay, how does that work?
The formula is straightforward. It is the total amount of money the insurer pays out in medical claims, divided by the total amount of money they collect in premiums from policyholders.
So when Abbott's numbers show resilient high volumes of surgeries and diagnostics, the numerator in that equation the claims being paid out spikes aggressively.
Exactly. The claims go through the roof.
But wait, why can't the insurers simply raise their prices to cover the difference? If their costs go up, just charge more for the insurance.
Because of the timing mismatch inherent to the insurance business.
Timing mismatch.
Yeah, insurers lock in their premium rates, which is the denominator in our equation, months in advance during open enrollment periods. They calculate those premiums based on expected utilization.
Oh, so if people get sick more often than they guessed.
Right. If the actual volume of treatments and surgeries comes in higher than they forecasted, they cannot retroactively charge you more money mid-year.
They are trapped.
They are completely trapped. The claims go up, the revenue stays flat, and their profit margins are instantly compressed. That is why UnitedHealth, Humana, Elevance Health, and CVS Health face immediate headwinds from Abbott's strong quarter.
Wow. Okay, so the insurers are losing because they are forced to subsidize the broader strength of the market. But Abbott also has direct competitors who are losing simply because they're getting outplayed in their specific product categories.
Yeah, we can start with the continuous glucose monitoring, or CGM, market. The specific losers here are Dexcom, ticker DXCM, and Senseonics Holdings, ticker SENS.
DXCM and SENS.
Yeah.
But if I am a nimble, innovative company like Senseonics, what is actually stopping me from stealing Abbott's market share? How does Abbott's quarterly success directly harm them?
The barriers are market share density and pricing power. Abbott is aggressively expanding its Libre technology. They're constantly improving their distribution networks and broadening their product range.
They're just everywhere.
Right. And when an established giant achieves that level of scale, it creates a suffocating environment for competitors. Abbott can afford to operate with lower profit margins on individual units because their overall volume is so massive.
Which means they can undercut the smaller players on price.
Exactly.
Forcing companies like Dexcom and Senseonics to burn cash just to acquire a single customer.
And the customer acquisition costs become crippling. I mean, if Abbott products are already stocked in every single pharmacy and heavily advertised on television, Dexcom and Senseonics have to spend an absolute fortune on marketing dollars just to convince a doctor or a patient to switch routines.
That sounds expensive.
Very. But the real bottleneck happens behind closed doors during negotiations with the health plans.
You were talking about the health plan formulary.
Yes. The formulary.
Let's make sure that concept is clear for you listening. A formulary is essentially the VIP list of approved, discounted drugs and devices that an insurance company will actually allow a doctor to prescribe to you.
That is exactly right. And that VIP list dictates success or failure in this industry, period.
So how does Abbott win that fight?
Well, when an insurance company is deciding which CGM device they will place on their formulary, they negotiate for rebates. They want the best possible price in exchange for giving a product access to their millions of policyholders.
And Abbott can afford to give them that price.
Yes. Abbott has the financial leverage to offer highly attractive bulk pricing to the insurers in exchange for exclusive or preferred placement on that formulary list. Senseonics and even a larger competitor like Dexcom just struggle to match those brutal economics.
So the competitors are fighting a two-front war. They are squeezed on the marketing side trying to reach the patient, and they are getting boxed out on the institutional side because they cannot out-negotiate Abbott for a spot on the insurance company's VIP list.
That's it exactly. And a nearly identical dynamic is actually playing out in the cancer screening market too.
Oh, okay. So who are the losers in that specific category?
The losers there are the challengers. Specifically, Guardant Health, ticker GH, and GRAIL, ticker GRAL.
GH and GRAL. Now, this traces entirely back to that $3.09 billion diagnostics revenue figure from the top of the show, specifically the growth of Cologuard.
Yes, exactly.
So if Abbott is dominating the cancer screening space, what are the actual physical hurdles stopping a company like Guardant from breaking through?
The barrier to entry for smaller companies really consists of three distinct hurdles. You have clinical adoption, reimbursement coding, and investor attention.
Okay, let's break those down. Let's look at clinical adoption first.
Right. So Abbott commands an enormous, highly entrenched army of sales representatives already embedded inside doctors' offices across the entire country.
They're already in the door.
Right in the door. Getting a physician to change their daily prescribing habit and adopt a new, unfamiliar screening test from Guardant Health is incredibly difficult, especially when the Abbott representative is standing in their office every single week reinforcing the Cologuard platform.
Because habit is a powerful force in medicine. Doctors prescribe what they know and what they trust.
Exactly.
What about the second hurdle, reimbursement? Is that the same formulary negotiation we just discussed with the glucose monitors?
It is related, but it's honestly even more complex.
Really? How so?
Well, securing reimbursement codes from Medicare and private insurers is a bureaucratic nightmare. To get an insurer to agree to pay for a new cancer screening test, a company has to provide massive, undeniable mountains of clinical trial data.
To prove it works.
Not just that it works, but to prove the test actually works and saves money long-term for the insurer.
Ah, right. Because if it doesn't save the money, why pay for it?
Exactly. And Abbott possesses the institutional machinery, the regulatory lawyers, and the capital to push that data through the system rapidly. Smaller challengers are forced to burn through their limited cash reserves for years just to prove to insurers that their tests are worth covering.
So you could have the most innovative cancer screening technology in the world, but if Medicare doesn't issue a billing code for it, the technology effectively does not exist.
Yep. Without a billing code, doctors cannot get paid for using it, so they simply won't use it, which leads directly to the third hurdle, investor attention.
Right, because investors want a return.
Exactly. Institutional capital always flows toward the path of least resistance.
So if you are an institutional investor analyzing the healthcare sector, and you see Abbott consistently delivering mid-teens growth with a widely adopted, fully reimbursed platform like Cologuard, you are far less likely to risk your funds on smaller, unproven challengers navigating a bureaucratic maze,
Exactly. The money inherently flows toward the established winner.
which actively starves Guardant Health and Gerald of the capital they need to fund their own growth.
Precisely. They just run out of oxygen.
Wow, okay. Well, we have mapped out the exact mechanics driving the market reaction to this single financial update. To summarize the landscape for you,
Okay.
Abbott's raised 2026 profit forecast and strong second quarter revenues revealed clear winners in the diversified medical tech space and surgical hardware companies.
Right.
The undeniable demand for cardiovascular devices, diabetes technology, and cancer screening proves that medical spending is non-discretionary and highly resilient.
Absolutely.
And on the other side of the equation, we identified clear losers among the managed care insurers whose profit margins will be compressed by this unexpected volume of medical claims. We also laid out why direct market competitors in continuous glucose monitoring and cancer screening are losing ground as they struggle to match Abbott's scale, distribution networks, and brutal pricing power.
It's a tough market for the smaller guys.
It really is. Now, this is not financial advice or buy or sell recommendations.
Right.
This is purely the opinion of the author.
And as we wrap up today's analysis, just consider the long-term reality of the mechanics we explored today. Massive corporations like Abbott are building undeniable, impenetrable scale that makes it exceedingly difficult for smaller challengers to secure health plan coverage, clinical adoption, and crucial investor capital.
It's a massive wall to climb.
It is. You have to ask yourself what that level of consolidation means for the future pipeline of medical innovation. When the financial barrier to entry becomes that high, how many breakthrough technologies might wither on the vine simply because they cannot out-negotiate the giants?